Often you'll have inside information regarding assets in your possession, particularly unique assets over which you have a lot of familiarity, such as a business that you've acquired, or even particular real estate. I mean, you're an insider typically as to assets of that nature, at least, that you own. So that puts you in a position to have special information that you can utilize to your advantage. And I would argue that if you own a business, that you're probably, I mean, if you have the ability to step back and think objectively about it, you're probably in a better position than anyone else to say what you think that business is going to do 10, 15 years from now. Now, it may turn out that you have very little prophetic powers in this way, but my argument is that yours are going to be at least as good, or they should be, as anyone else's. And it might be, in fact, that you have substantial reason to believe that this asset is going to triple in value in the next 7 or 8 years. You know what's being discussed in terms of transactions and contracts and potential purchases and expansion, mergers, things such as that. So if you're looking at doing some planning so that you're going to minimize the hit when you die, now you have to step back as to a large asset like that, and you have to ask this sort of threshold question. Do I want to plan on keeping this in my estate, which means that it's going to appreciate greatly, and I'm going to be hit with estate taxes at death that somebody's going to have to pay, which can be 45%, incidentally, is the upper bracket presently. It could go up, but I don't think that that's going to disappear despite what exists presently in the code. It's simply something that has a lot of psychological or symbolic value to Congress and in, quite frankly, the minds of the public in general. So if we assume that you'd be looking at 45% taxes at death, you have to say, well, how do I want to handle this asset? Another way I can do it is I can transfer part of the asset out now. And the asset right now, by a third-party objective evaluation, we're not talking about fraud here. We're talking about if you bring in a third party to independently value your business, that number might be, in your personal opinion, substantially less than it's worth. That creates a sort of, for lack of a better phrase, a sort of arbitrage opportunity, meaning you can take advantage of that disparity between your subjective opinion and the objective opinion of business valuators. The IRS is interested in the objective opinion of business valuators. So do you want to seize that opportunity now when your business may be worth very little? Your business, in fact, may be worth nothing if it's something you started relatively recently. But let's not assume that. Let's assume you have a business, you've been in business for a while, you have some earnings records, maybe 5 years or so, and that's going to be assigned a value, whether it's a present value of future cash flows, whether it's based on comparable transactions in your industry. Again, this is a show we've done before. I encourage you to do a search on DadsDivorce.com, and I think you can find the previous show. Anyway, however that valuation is done, you suspect that there would be a substantial disparity there. Well, it may very well make sense for you to make a transfer during your lifetime, but it's not an easy call because you have to also say, do I foresee myself selling this down the road? And that would also require you to consider the possibility of transferring it today. So there are a variety of scenarios that you have to contemplate as you look forward that will dictate or suggest to you at least what you should do now. And it now makes sense for you to do nothing, to keep it in your name, continue to run it as you are because of plans down the road. It may mean that you should think about a gift now to someone, or it may be that you should consider a sale to someone. When I say someone, I generally mean an insider transaction. I'm not talking about a sale for purposes of moving on independently of asset protection / estate planning issues. It's a separate discussion to talk about whether you should sell the asset now and move on. That's not the focus of this series of discussions. We'll come to that, incidentally. It's an important discussion we should have. So one scenario is you simply sell it to an insider. You sell it to family members, adult children, others that you would want to have control of the asset ultimately. And that's an opportunity using the mechanisms we mentioned before. We talked about the fact that when you make a lifetime gift, you have your $1 million lifetime credit in which you can transfer assets without gift tax. You have your $12,000 per year per donee, per spouse, annual exclusion, and you have a couple of other opportunities that relate to gifting. So you can take advantage of that often to get it out of your estate completely. That's called estate depletion. Another thing another phrase that's used to describe this general area of strategies is called asset freezes. Asset freezes means that you create a new value that's locked in based on today's worth. And as a result, you know that, for example, if you had an asset that's worth $1 million and you get back installment notes worth $1 million and you died 20 years from now, you know that the value of those notes, coupled with whatever interest you might have earned, is going to be the extent, at most, it's going to be in your estate when you die down the road. Now let's assume that the asset you transferred now has gone from $1 million in value to $100 million. Well, you know that that's safely out of your estate. That's an example of an asset freeze, where you've through a substitution or other device, you've frozen that value that's going to appear in your estate down the road, and you have this suspicion that that value is otherwise going to appreciate substantially. So as I talk to you about these considerations in terms of planning steps that you can take during your lifetime, you can see that it can get pretty complicated. But I want to emphasize to you that while there are a variety of ways to use these tools, really the number of tools that are in your toolbox are not that numerous. And it's just a matter of considering the complications or the variety of ways in which those tools can be used. And of course you have to incorporate into that tax and other legal considerations. So I realize in this show I probably tried to cover too much, so let me kind of summarize here as we wrap up this discussion. When we're thinking about doing these transactions in our lifetime, we want to choose the course of action that's going to be the most likely case scenario. And that's going to consider these tax considerations I mentioned, as well as the practical concerns that you have about where you want those assets to end up. We also want to consider what's likely course regarding the appreciation of the assets. We want to choose from our options. Our options are that we make a gift, and options are that we make a sale of some sort, or a gift/sale, which is a sort of split gift is what it's termed. One thing that will notoriously trigger a lot of IRS concern is whenever you do a transaction, any one of those, in which you retain part of the interest. That's a little different. It's not a split gift, it's not a split sale, it's instead a gift in which you've retained an interest, or a sale in which you've retained an interest. The IRS scrutinizes those transactions because they think there's a lot of opportunity for mischief there. And there is a lot of opportunity for mischief there. Because you see, if you can transfer an asset and still enjoy that personally for the balance of your life, and have that asset as being considered out of your estate for the most part, then that's kind of the best of all worlds, isn't it? You got the asset out of your estate in a value that, in a way that minimized your tax obligations, estate and gift presumably. At the same time, you've enjoyed the use of the asset for the balance of your lifetime, meaning you've had a lot of control over that. You've had possession, enjoyment. Isn't that the best of all worlds? That's like having your cake and eating it too. Well, those are the sorts of transactions that the IRS really scrutinizes. There's a special set of rules that speak directly to that. And there's sections 2701 through I think 2705 of the code. Not that any of you, I think, are going to run from this discussion and pull that off the shelf, but if you are interested in the discussion, you can go to it. And sections 2701 through 2705, and those provisions in the statute are specifically intended for transactions in which you attempt to retain some level of control and you're doing a transfer to someone in the family. Now, there are rules that will permit you to make those sorts of transfers to family members, but you got to do it in a specific way. And rather than start down that road in this discussion, I'm going to reserve that for our next video. But I encourage you to come back and tune back in. I hope this is exciting stuff for you. It should be, because when we're talking about tactics here that can save you a lot of money, it may not be as sexy as something that you can go out and spend tomorrow, but it's real, and it's there, and it's fairly certain based on the things we've discussed here today. So I encourage you to come back. We'll continue along this discussion. We'll focus on the details of these transactions that you can take during your lifetime that will minimize your taxes, optimize your use and control of your assets. I hope that this has been helpful to you. We're trying to take care of your assets for you in addition to your other needs. This is Joe Cordell, another episode of Cash Counsel. See you next time.